that don't want what we know out there.
How a person can go from really almost nothing to becoming a millionaire by owning rental properties.
He would always buy these flip houses, and I just remember thinking, this guy is crazy. Why would he buy that house?
In the past decade, there's been a huge surge in the peer-to-peer short-term rental market.
Become an insider. So you have to know the rules before you get in the game.
Every second counts. So make every second count.
Welcome to the Real Estate Jam. Whether you're just beginning or the best of the best, we're glad you're here. We will share successes, failures, and strategies for the action-taking real estate investor. And now to your hosts, JD and Melissa.
Hi guys, welcome to the Real Estate Jam podcast. I'm JD with my wonderful co-host.
Hi JD, how are you?
I'm doing great. How are you?
Good.
We've had a pretty busy day, pretty busy week, but I am excited. I think this is going to be our first guest inside of our new podcast room and starting off 2024 with a bang.
Mm-hmm.
I don't know. Hopefully everything works fine. You guys can hear us all right. So we're really excited. We get these questions all the time. And so we decided to bring in an industry expert to help share some of his knowledge on the specific tax issues that we as investors hit every day. And so we're really excited to introduce you guys to Jon Conners. He has a master's degree in finance. He's an author. He wrote Navigating the Tax Code to Riches. He's the founder of lesstax.us. And Jon, we're super excited.
Yeah,
Thank you for making time for us today. I know you're out there living the digital nomad lifestyle.
Thanks, JD. Thanks, Melissa, for having me. I really appreciate being here today.
Yeah, we do you. And I think we're going to talk about the STR loophole, but it's definitely really not a loophole. It's I don't know why people call it that because it's just one of the things that we can take advantage of with the IRS, correct?
Yeah, for sure. I didn't know if you wanted to talk about background first, just so people knew who I was.
Oh, sure.
I would love to get it. So I'm Jon Conners. I'm a tax activist and a tax strategist, and so I'm really committed to getting, Less Tax US and the team I have and I are really committed in making sure every single person in America keeps as much of their money as possible. And to be honest, I think the IRS is cool with that now too. They're at least saying that those same words is that they might not tell you the best ways to do it, but we're committed to legally keeping as much money in your pocket as possible. And real estate investments, I didn't know that the tax code, I thought it was punitive. I thought that the IRS were bad guys looking to get us. And really, as I started to read it and get competent in it, studying for the enrolled agent exam, I realized real estate is such a blessed, it's blessed by the tax code. There is no other asset that is given so much, so many credits, so much kudos, so many loophole opportunities. Like you said, the STR is not really a loophole. CPAs hate the word loophole.
Yeah.
But I'm just really excited to be here with you, and I love teaming up with real estate competent individuals because that's how you keep the most money in your pocket.
Yeah, we completely agree, and I think that there's definitely a mindset shift that people have to make in regards to taxes, right? I don't want to pay taxes. You don't want to pay taxes. We want to stay within the confines of the law. But the mindset shift that instead of looking at the tax code as the enemy, you start to look at it as how can I make this work best for me and my business and my family and the people that I know? And it really gives you a different outlook. And the other thing that I always like to mention is, hey, if you're paying taxes, that means you made money, right? That's the thing. Now, we want to minimize our tax, legally minimize all of our tax obligation. And there's some really cool ways, like you mentioned, for real estate investors and homeowners, but real estate investors to do that. So being that we're in a short-term rental market and a lot of our listeners are short-term rental people, why don't we explain for them that don't know some of these quote unquote loopholes that make short-term rental and investing great as far as tax comes.
Great, thank you. So this is for Melissa's target audience of a high wage W-2 earner.
Yeah.
Somebody who's a doctor, somebody who's a lawyer, who's got 500K of revenue coming in every year on a W-2 income. They want as much as possible, at least the ones I know, they want to reduce their taxable income. And my father was a high income earner in his peak career time, and he wasn't aware of this. And actually, I don't think the Tax Cuts and Jobs Act had been passed at that time yet. So the opportunity wasn't there, but typically W-2 workers can't classify themselves as real estate investors. I mean, as real estate professionals,
right?
Because they don't spend thousands of hours doing real estate. Well, this is the one place where if you spend 100 hours, 2 hours a week on a short-term real estate business with an average rental of 7 days a week, I mean, seven day stays for the clients, or 30 days stay if you're cooking a breakfast and you're going over and above. So these are the weird thresholds. Your average guest stay is either 7 days if you're just doing standard services, or 30 days if you're doing B&B services. And you're allowed with 100 hours, 2 hours a week and if you're the head of the business, you're running it as the managing partner, basically. You can't hire a property manager in this case. So you work on it part-time. You've automated systems and structures like Melissa and JD can tell you about. I'm not the operations guy. I'm just the tax guy. And ultimately, you're able to take if you meet these certain thresholds, you're able to take your active income and offset it against active real estate investments. Otherwise, it would be a passive activity you wouldn't be able to do. So this is the one magic loophole that every high earning W-2 worker needs to know about. And it is really like the IRS is blessing us with the opportunity to take money that would go to them and instead invest it in our assets and in our future.
Yeah, and that's huge. And meeting those thresholds is important. Now, we do want to say we are not representing anybody, so this is knowledge based, not something you should apply without talking to your own CPA, your own lawyer, tax professionals.
Yeah.
But this is things that we know work for clients and other investors, and is something for you to ask your CPA about when you're getting ready to purchase a short-term rental investment or make those kind of decisions. It's something that you need to know about so that you can bring it up with them. Okay, well, let's dive into that. So when you're talking about writing off your active income based off of I guess it is passive losses that you're getting from the real estate that you actively manage. Is that right?
This allows what normally would be considered passive, it becomes active. So that's what the loophole is. It's the one moment where real estate investment becomes active for the part-time real estate operator. And with depreciation, with the magic of double declining depreciation, I mean, you're literally allowed to take, if you put a serious down payment down and you start depreciating your asset, you put 50K down, you end up having some operating income because obviously it's a short-term rental. You have to at least show and prove that you're renting it out on Airbnb or VRBO, or even glamping land development. You can do it for on Hip Camp. So this could work for even the more constrained investor who maybe has 120K of W-2 income. They can buy a little glamping plot in Florida. It would be a gorgeous environment to do so. Put up a tent platform, a bathroom, and a shower, and there you go. That can be the investment into that infrastructure. Could also be could be offset by the W-2 income that this boutique operator has. It basically allows boutique operators to work part-time and move it from passive to active.
Yeah,
That's cool.
that is super cool, and we see this. What is the service that all those doctors come to you from?
Semi-retired MD.
Yeah, semi-retired MD. That is their entire strategy. Is they get these guys, and so when they're looking to purchase real estate, they're only looking at purchasing real estate that they can manage themselves for the year. I don't know if it changes. You manage it for a year, what happens next year. I'm not sure about that, but their whole goal is to manage it for a year by themselves so that they can offset all of this income. And when they're making substantial W-2 income from their job, being able to depreciate, and you can do your accelerated depreciation and all of that kind of stuff, cost seg analysis to really
You need to have the cost seg analysis in order to get depreciation. So it's a couple $1,000 out of your pocket. If you don't have a cost segregation study, you cannot take the depreciation. So it's highly recommended if you're going to do this short-term rental loophole strategy, unless you're doing a glamping investment. There's not a lot of depreciation on a tent platform and a bathroom and a shower. You know what I mean? But as far as a beautiful Destin, Florida multiplex, different story. You want to be able to write that off as quickly as possible, especially in your high earning years.
Yeah.
Yeah,
Sure.
absolutely. So that is what people in the industry identify as the STR loophole, right?
Yes.
Why do you think CPAs despise the term loophole?
My dad's a CPA. I love him dearly. We were just chatting about taxes a few minutes ago, and they're just really scared of losing their license, and they're taught to be ultra conservative. So the reason why I like being an enrolled agent, even though it's kind of like the CPA of tax, it's the credential that is well established in the tax side of things, and not a CPA, is because I'm looking as much as I can into the rules to see where we can find the most benefit for our clients. And most CPAs, not all, but most CPAs that I know are looking at the rules and feel bound by the rules.
Yeah.
You know what I mean? And I'm obviously not asking anyone to break any rules, but we're looking to find as much gray area as possible to get the most return for our clients.
Yeah, and one of the things that you had mentioned, I think is important before we were recording, is if you could go into how you feel about being audited and having to manage that level of risk when you're doing some of these not as common tax strategies.
Well said. So 90% of people take the standard deduction in when they're doing their taxes. They don't itemize. They don't always get the opportunity to write off their mortgages because it's just the tax code is written in such a way it's easier. So those of us who do itemize our deductions, who take business expenses, we need to keep impeccable records. Because if you have a tax strategy that is not backed up by impeccable records, you have a very major risk hole to deal with, a big risk pool to work on. But if you keep impeccable records, the IRS is pretty cool, you know what I mean? And if you invite an audit as like a health checkup, and you just look at it that way, my father doesn't look at it that way. He's scared of being audited. He thinks an audit is a sign of bad health. And for me and my clients, we look at audits as a checkup to make sure we're in good health. And if we're interpreting the rules a certain way and they tell us another way, we're not lying. We're just getting clear.
Yeah, I think it's easy to talk about having impeccable records until you're running a dozen short-term rentals by yourself, and your filing system is 12 different shoe boxes that you dump all your receipts in. At the end of the year, somebody has to go through and check all those out. Now, that's the way that I prefer to run my business. But Melissa, on the other hand, has some really good strategies and processes to keep us out of trouble. And part of that's employing a good CPA, making sure that the books are done and we're reconciling accounts and stuff every month. But there's really, it's especially if you're just getting into it and you're one of these high income W-2 earners, you can, there's apps, you can scan your receipts, you can
That's it.
set up a separate bank account, you can run everything before that. And it's easier to start out the right way than it is to try to go back and fix the
Fix
crap
the
that
mess.
you threw in the shoebox.
Well said. Expensify is $5 a month.
Yeah.
You don't even need QuickBooks. If you have Expensify and a separate business bank account, you can be good.
Yeah, absolutely. Okay, so one of the things we were talking about before we got on here also was the Augusta Rule. Can you explain that to the audience and then kind of walk them through? Because we do get a lot of questions about that as well.
Yeah, when you Google short-term rental loophole, occasionally you'll get the Augusta Rule pop up. And the Augusta Rule is named after Augusta, Georgia, where people there had this great opportunity to rent their homes for the Masters tournament, and they didn't want to report their income. And they're they're well-off people in Georgia that organized and lobbied, and they got a loophole put into the tax code just for them. So you gotta give them props.
Yeah.
And so it's the only time the IRS says, "Don't tell me anything." And they don't want to know your expenses, and they don't want to know your income. If you rent out your primary residence for 14 days and you compare it to another short-term rental price, you can't say, "I'm renting out to my family business for $500 a night," when everything else around you is at $200 a night. They'd ding you for it.
Right.
And you need to keep impeccable records, as always, and just in case of audit. But ultimately, if you use VRBO and Airbnb, you have the right to subtract that 14-day stay, or up to 14 days in the 365-year calendar. And that is a short-term rental benefit of the tax code as well.
So you can do that, just renting it out to random people for 2 weeks and receiving that income, and then not having to report it. If it was your primary residence, you can rent it out for the 2 weeks and not do it. Or you can rent it out to your own business for 2 weeks at the comparable rate, and then write that income off from the business. It's an expense, and it comes to you as income without any tax obligation.
No non-reportable income.
Yeah.
Exactly. So you get the business expense value of that if you have a full-on business. This is beyond the boutique real estate operation we were talking about. This is more like you're having executives come to your stay and having an offsite experience for them. And it could be a family business, could be a family trust. You know what I mean? Really, anything that you're doing that is making money, that you're running Schedule C income off of, if not an LLC or a more sophisticated business, you could definitely do that. That's a great way to do it, JD.
Yeah. So now, we've talked about kind of what the loophole is, and I'm wondering, what are the things that the high income earner needs to think about when they're going out, they're finding a good real estate agent, or they're going out and finding the property on their own? Is there any limitations on what kind of property it is, or which properties make a, better, does this apply to condos and townhouses and single family? Should it be of a certain monetary value in order to get the maximum amount of depreciation? How do they know from the tax side of it, what property they should be targeting?
Great question. I mean, well, firstly, I'm never going to step into the real estate expert's shoes.
Right.
That's Melissa and you, JD. You know what I mean? You're both here to guide people to the right purchasing decision and what works for their budget and so on and so forth. I mean, ultimately, the more expensive the property, the more depreciation value you get. And it depends on where you're at. Like, my dad's finishing his career. So if you're in a high earnings, like last 3 years of your career, and you want to maximize your tax benefit, buying a high value property and accelerating depreciation is key.
Yeah.
If you're in years where you're putting kids through college, and you know what I mean, and you have a different set of budgetary needs, then you might not need to really get that maximum benefit. So it does have to fit because a write-off, like you said, only comes with the amount of money you have, right? No, you never want to buy something too big for your budget just because you're excited about the opportunity for write-off.
Yeah.
You know what I mean? So,
And in the same token, you don't want to buy something that's negatively cash flowing to handle your W-2 income.
Some people would do that, actually.
Yes.
Some people would be cool with a negative cash flow if it's an asset that they're getting, they're just dropping their W-2 income because it puts them in less tax bracket. It's really dependent on the use case. I personally am not in the highest income bracket where I need to take real estate hits in order to lower my income. So I prefer a cash flow positive investment. That's what Melissa and I were originally spoke about in the first place. So that definitely works for my needs. And it really depends on each investor's tax situation and earnings situation.
Yeah, absolutely. I will say that I don't think that is good real estate investing practice, but that might be a great tax strategy. But but we each got to stay in our own lane when it comes to that. The one thing that I want to identify though is what your income is going to be, and that you can figure out before you ever purchase the property ballpark numbers of what you're going to be able to write off. So if you're making $500,000 a year in active income as a doctor, the $20,000 property that you bought, as a studio apartment, that's not going to offset very much of your income, even with the accelerated depreciation and all of that. That's going to be a small write-off. So making sure that the property that you're targeting meets the goal for the tax write-off, or I guess you could do this with multiple properties, right?
100%.
Yeah.
There's a woman I saw in the Bigger Pockets podcast that has developed a short-term rental strategy around the Cleveland Clinic, and she bought 7 triplexes and has $350,000 a year of income. She's obviously buying for cash flow, not for tax reduction.
Right.
So, and she's actually investing in remodeling beyond the scope that normal people around that area would remodel, so that it looks good for her short-term viewers on Airbnb. You know what I mean? So she's maximizing her cost benefit analysis in a way that most of us would say that's crazy. But her income it speaks for itself.
Right.
So most times, if you're looking for a write-off, you're not looking for the huge cash flow return. You're just looking for something you can invest in, get some Airbnb customers in there, and then take the loss and drop your taxable income. That is usually the strategy for the high income earners. Rather than this woman was replacing a high income job with short-term rentals. So she wanted that rental income because she didn't want to work anymore besides doing her rental job.
Yeah, I was just gonna say we have some clients like that.
Yeah.
Which is so crazy for us because it just goes against everything that we think.
I don't care if it loses 50 grand a year. I just want it to write off. Okay. Here you go. All right. So one of the criteria that you identified in the beginning was a minimum of 2 hours a week is what would be required to equal that. It's not, is the rule 100 hours a year, or is it 2 hours a week? If you did 4 weeks or 4 hours in one time, or you took a week vacation,
100 hours a year.
Repairs.
100 hours a year is just easier for people to understand. About 2 hours a week, that would come down to 104 hours a year. But ultimately, at the end of the day, you just need to keep records, and you need to be the one. Nobody else can spend more time on the project than you.
Yeah.
So that's the key thing, is that you need to be the boutique GM, if you will. Yeah. This is the tax code's way of expressing that this is how a boutique GM these are the thresholds they need to reach in order to be at that level of operator. So they don't want you to buy a place and make it a passive investment, because that's not fair. You're getting active write-offs against your active income. So they're asking you to be the active operator, and you need to at least keep good records of, your own timesheet.
Is that what you need to do? Do you need to say, hey, started working at 10 o'clock in the morning, ended working at 12 p.m.?
And then what's
typically
your task
what was this?
And then write in there like a brief about what you were doing during that time.
Yeah, there's apps that work for it. And also I usually use a Google Sheet for my clients.
Yeah.
And it's just basically like, on this day I did 5 hours of admin. You know, you need to be specific enough that it will hold muster against the IRS. You don't need to be super granular. You know what I mean? Just like with many consulting clients, how you bill them, you act like you're billing yourself.
Right. Yeah, that makes a lot of sense. So I guess if you are looking to if you're an investor and you're a high net worth individual and you're looking about, how to put this in place, and maybe they wanted to reach out to you and find some more information on what you guys are doing over there, and how they can get in contact with you to find out more, where should we send them?
Please. Yeah. So lesstax.us is the website URL and the company name. So it works. And then lesstax@proton.me, proton.me, a secure encrypted email service, is how you get a hold of me. And I can connect you to the team. I'd love to be working with professionals like Melissa and UJD to really find use cases. I think this time of high capital costs are perfect for high wage earning W-2 earners to get into the market right now and maybe get an asset that might not be the best cash flow positive asset to date, but once the mortgage rates come down a little bit, as we're all hoping it will happen sooner rather than later,
right,
and the cash flow then goes up. So this is a perfect opportunity for the short-term rental loophole. It's, to me, the people that should be buying right now are people who have income to offset, because the IRS is saying basically, you could take what you would give us and instead invest in your future.
Yeah. I think that's great. I think that's one of the biggest. Now, you do have a proposition for the listeners if they want a free copy of your book, and why don't you explain that for us?
Oh, thank you, JD. Yeah. So if any listeners out here are interested in getting their taxes done for free, and would like a free copy of Navigating the Tax Code to Wealth, I am a digital nomad, and I rode a bicycle across the United States, and I've stayed in hundreds of people's homes, and I am a very good house guest. And if you have a guest room or a couch, or and you put me up for 3 to 5 days, and I'm heading by your area, please reach out to me. I'd love to hang out with you, get you on social media at lesstax_US on Instagram, and share your story, and maybe invite some of your friends over to meet me and learn about the short-term rental loophole and have conversations about investing in the Emerald Coast with short-term properties.
Awesome.
That's very cool.
Yeah, that's great. Okay, Jon, well, we really appreciate your time today. Thank you for sharing your wisdom with our audience. I think that this is a phenomenal program that a lot of high income earners either, one, don't know about because they don't have the time to learn all these new tax strategies. So getting this information out to the public is great. And your goal of having Americans pay less to the tax man is one that sits near and dear to my heart. So we do appreciate it.
Thanks, Jon.
Thank you, Melissa. Thank you, JD. It's been really a pleasure being on here.
Awesome. We'll see you later.
Thank you for listening to the Real Estate Jam. We hope you enjoyed today's episode. For more information, check out our website, therealestatejam.com, or find us on Instagram, Facebook, and Twitter at The Real Estate Jam. If you have any questions, feel free to drop us an email at therealestatejam@gmail.com. See you next episode.